All right, welcome, financial professionals. I'm Greg Spaeth, Chief Strategic Initiative Officer here at E4, and today I'm joined with AJ Stafslien, internal wholesaler at North American Life Insurance Company. Thank you guys for everybody for joining, and we're here to help build relationships and empower wins. AJ, thank you so much for joining us, and if you could just give a brief background for you and being with North American.
Absolutely. Well, I appreciate the time. I appreciate everybody tuning into this. Yeah, I've actually been in the financial services industry for 25 years. And I spent 14 years in the MGA world with the life, annuities, long-term care, disability, MedSup, final expense, you name it, 75 different carriers, dealt with all of them. I've been a North American internal wholesaler now. My 11-year anniversary was yesterday, as a matter of fact.
Awesome. Well, congratulations on that. And thank you for joining us. Today, what we'd like to do is really talk about creating your ideal savings account. It's kind of a different way to think about income planning for your clients. And it's just a unique way that you can engage the clients in a discussion about this. Why the conversation is different in terms of creating an ideal savings account, because if you really think about it, the client is thinking to themselves, hey, if I go and meet with a financial advisor, most of the time they're going to be talking about some kind of product, right? Whereas with E4, the approach that we'd like to take is starting with the priorities of the client. And the ideal savings account definitely does that. And it allows you to actually help design the solution for them when you get them to engage about what they would have inside their ideal savings account. And I'm going to just set the table real quickly. When you do this with a client and you're asking them to be a part of the conversation, you're either having a whiteboard, having them write that down, or you're writing it down on a whiteboard for them, or you're having them write it on a piece of paper. It allows you to have them engage in what that ideal savings account could look like. And it really starts with the question that actually changes everything in terms of the dialogue that you're going to have with them. So let's start with this. If you're sitting down with your clients and you say to them, hey, listen, if you could create the ideal savings account, what would you want it to do? What would you want it to have in it? What are the things that are going to be important to you? And then you pause. You wait for them to give some kind of response back in terms of like, either they're going to say, I don't know. There's a lot of things that I'd like it to have, but if you could create that and we were able to do that today for you, what would you like it to do? The first thing that they're going to say, and I'm going to give you the 7 most common. If there's an 8th and they say something to you, you write it on the piece of paper, you write it on the board for them, because that's important to them and their ideal savings account. And maybe it is going to be available through what we're going to be talking about in the strategy today. So first, most important, what are they going to say? I'd like to have some type of growth. If we could do that, client wants growth. Well, what kind of growth would you like to have? What's a reasonable amount of growth that you would want inside your ideal savings account? Now, I've had financial advisors where the client has said, well, I'd like 20% growth. Okay, with that, what did you also have that goes along with that? And that was probably some risk, right? But it's your ideal savings account. Most people think is, it's in my bank, it's in a CD, it's in something that's got some type of growth that's consistent. So what's a reasonable rate of return? And most clients are going to say somewhere between 4 to 6%. If they say 8%, write it down because it's important to them. But the reality is that when you get done with putting this together, it's about saying what this is going to do in terms of creating that ideal savings account for them. And it also creates the consistency and it takes out the speculation. Second item that's going to be on there, well, if they want growth, what's the other thing that they don't want? And that's typically they don't want any loss. Now, they'll say, I don't want to lose it. If they say they don't want to lose it, you want to say in return, what do you mean? Like you put it somewhere, like it's underneath your mattress? Did you bury it in the backyard? And they're going to say, no, I just don't want any market risk. If it's going to be my ideal savings account, I'd like to minimize that as much as possible. Avoid the anxiety of, the market volatility that I could experience in what they might already have, and protect their principal. Third on that list, so as you're kind of going through this, you're seeing the direction that I might be going, is if it's it has growth, right? There is no loss, and they already have some type of plan that they're already working on. They may say something like, hey, if I could defer any taxes because I have some money that I'm already paying taxes on an annual basis, if I could do that, that would be great. So that would be important to you as part of your ideal savings account. Yep, I'd love to be able to not have any, tax drag on what I'm doing. And it ultimately, if you could put it in there and it's growing tax deferred, right, you got more efficient compounding taking place with your ideal savings account. So Mr. and Mrs. Smith, Mr. and Jones, if this is important to you, then let's put that down as a priority for you. The next one, kind of a given as you see on the slide, right? If it is going in tax deferred and you were going to take it out later on down the road, how would you like to receive that? Would you like to pay the bill or tip, as the one advisor one time said to me, do you want to be tipping the government when you're taking out your money for your retirement? And they don't. If they can control taxes in retirement, why wouldn't they? Plus, it allows for strategic income planning for them because they might have other assets that are going to pay taxes. If taxes go up in the future, which most people would say with our government and their ability to spend so well, we're going to be paying taxes in the future. But having a strategic income plan, having their ideal savings account work for them on their tax planning in the future, absolutely. All right, so let's write that down. Tax-free income is important to you. Well, if you got tax-free income, there might be some other things that would be important to you. Mr. and Ms. Smith, would being able to have some type of guarantees inside your ideal savings account be important to you? Well, how about some growth guarantees, maybe some income guarantees or a legacy guarantee? Would those items be important to you, right? Predictability matters for you and your ideal savings account. Is that important to you? And they're going to say, absolutely. If I can have that, I would love that. Now, number 6 is going to be a little bit different because you're going to probably have to lead them there. They may not give you this or say something like this. Sometimes it does happen. But the 6th most important thing to them in their ideal savings account they aren't aware of, and that is some type of long-term care, right? If their health events change, it can change everything in terms of their retirement planning. Now, if your ideal savings account had some kind of living benefits that you could access, if you needed care, would that be important to you and your spouse? Why not protect your savings plus control the dignity of how you enjoy your life if something were to happen to you, if there was a health concern? And at the end of the day, this is always an area where they're thinking, I can do that. I can actually have a product that can do this for me. I can have a solution, an ideal savings account. If we could do that, would that be important to you? Yes, it would. And finally, this should have been number 1, which is a legacy. If you were able to leave a legacy behind for your family, and like I said earlier, instead of tipping the government on the way out, you're giving that tip to your family and creating some kind of income tax-free transfer to your family members, would that be important to you, right? Who do you love more? Do you love the government or do you love your family more? And it really is an area where you can focus on intentional wealth transfer to your individual family members or what's important to you, whether it's a charity or your family. Now, the ideal savings account, right? You've gone through this. The client might put down something like, well, I'd like a benefit that would benefit me on my Social Security. Well, okay, write that down as number 8. And I'm going to let AJ talk a little bit about that. That might be number 8 for them. But the reality is that you're looking at creating an ideal savings account for your client that actually has growth, no loss, it's tax deferred, and can be taken out tax-free and with tax-free income. You have guarantees. There is a living benefit available in your ideal savings account, and there is a ability to transfer the assets to your legacy income tax-free. So the reality is for most clients, you want to ask the question, Mr. and Mrs. Smith, if we were able to do these things for you, if we created a product that was available, when would you want to know about it? Now, the majority of the clients are going to say something like, well, I'd love to know about it today. Yesterday, I've even had an advisor that one time said his client said, how about 10, 15 years ago, I wish I would have known about this. And the reality is that it is available today. It actually exists. It's an IRS approved. It does require, that is the one caveat here, it does require qualification. And it's a strategy, and it's got a product mix that allows for your clients to take advantage of what I like to call IRS Section 7702 of the IRS code. It's cash value life insurance. And more importantly, it's an index universal life, which North American has great products and indexes to do that. And it's often misunderstood. And the reason why is it's not about what it is. It's actually about what it does for your clients. How many products out there can actually give 4 to 6% reasonable growth, have no market risk in an index universal life, which is annual reset? If you don't know what that is, you want to talk to your RVP at E4 Insurance Services, and they will help you understand that. And North American has a ton of stuff that actually helps you explain that to the clients. Third, tax deferred growth, which you have with an index universal life, tax-free income if it's properly structured. It also has guarantees, which AJ is going to talk about guaranteed income inside of life insurance product, which is awesome. Finally, living benefits or long-term care benefits and income tax-free legacy to your family. That is a unique way that I've seen other advisors engage their clients to get them to understand that it's not about what it is, it's about what a product can do. And what I'd like to do is I'd like to hand it off to AJ so that he can kind of talk about their newest product that they have available that actually meets these 7 most common items that a client would want in an ideal savings account.
Yes, again, my name is AJ Stafslien with North American. Very excited to be on the call today and just hit on pretty much everything that Greg was talking about. Those 7 main talking points that somebody might be looking for the ideal savings account. And really, our answer to that right now is our Secure Horizon IUL. It is an index universal life plan. It's mainly going to be used for accumulation, but of course, don't forget it is life insurance first and foremost, so the death benefit is going to be tax-free. What makes it unique, this is the question that people ask us all the time. Why is this different from other IULs out there? How is this different? Why does it make this more attractive? I call it optionality, okay? It's a word I learned about 2 years ago. I use it all the time when I'm talking about Secure Horizon because this product has optionality unlike any other IUL I've seen in the industry, okay? So when we talk about optionality, we're talking about best-in-class IUL design. Why is that? Well, industry-leading income, okay? So whether you're doing an IUL for accumulation and you're utilizing it maybe for 10 or 15, 20 years, whether it's a participating loan or a standard loan or guaranteed income, we have that in the Secure Horizon IUL. Okay, so the guaranteed income option is something that most people are used to more probably on the annuity side, to be honest with you, but now it's trickling into the life side. There's a couple other products that have it. We have it as well. So obviously, again, you could use the standard loans like a lot of people have done in the past or the participating loans, but now the optionality of having a guaranteed income is in play with the Secure Horizon. Also, diversified index options. You have your S&P 500, you have your NASDAQ, you have all those different ones, right? Well, there's a few different ones that we have at the Secure Horizon that were driven by a nexus, okay? Those are going to be proprietary indices that have extremely high participation rates. And when I say participation rates, I don't mean just participation rates up front. I'm talking about guaranteed participation rates. The lowest it could ever be on a 1-year chassis with us, with the Secure Horizon, is 100%. And the 3-year chassis are 150% on the guaranteed minimum participation rates. So again, this is just part of the optionality. I'm going to get a little bit even further into that. Also, when we're talking about IULs, people want to know, like, what index options do I choose? Which ones do I talk about? There is a fantastic option on this product that a lot of people are choosing right now, and you're going to understand why when I show it to you. It's called the S&P 500 Dual Trigger Strategy. This is the only IUL in the industry that has it. Simply put, if the index performance is greater than or equal to 0, the client gets an 8% return. If the S&P is less than 0, but greater than negative 10, they still get a positive 2. So think about that. The S&P 500, anything over minus 10 for the year, the client is getting a positive. And anybody who's been doing IUL over the past 10 or 15 years knows how challenging it is to overcome a 0. Just the conversation point to the client. This alleviates some of that pain, right? So if you think about that, anything over minus 10, you're getting a positive. Anything that's over 0, they're getting an 8% return for the year. Very, very unique strategy. I've had an index product for 20 years. I wish I had this as an option because I would always put a portion in the S&P dual trigger strategy. And really what this has done, if you back tested this, if the S&P dual trigger was here the last 30 years, 86% of the time, it would have been a positive return for the clients. That is very powerful. Now, again, we still have the regular S&P options like your annual point to point with the cap, which is going to be extremely competitive at 10.5. We have your S&P 500 where you have the uncapped strategies as well. But I think a lot of people are going to gravitate towards the S&P 500 dual trigger just because of the chances of the positive frequency, especially when the market's been going like this for many, many years. So that's just part of the optionality that you get in the Secure Horizon that you're not going to get in other products. Again, I'm going to keep talking optionality, okay? There's something in the Secure Horizon built in, no additional cost, and you're going to see it on the illustrations. There's an additional column called the longevity benefit base. Another name for it is the secure stage, okay? It's just a supplemental benefit endorsement, no additional cost built into all of our plans. What does that mean? There's 3 things that you can use the longevity benefit base for. The life pay income benefit, the plan gap, I'll touch on that in a little bit, which is more Social Security driven, and then the enhanced death benefit. This is how it works. So your longevity benefit base does this. It takes the credited interest that a client had in their policy times 150%. So in this example, let's say the client paid in $300,000 and their credited interest of $300,000 as well. Your account value is at $600,000. But now to get the longevity benefit base, take that $300,000 in credited interest times 150%. Now you have $450,000 that you slap on top of the $300,000 plan premium. That is what gives you the longevity benefit base. Okay, so now that it's $750, you're like, I still don't know what you mean. What does that mean for me? What are my options? 3 options here. Don't have to, but you can. The life pay benefit. If they decide they want to turn on the lifetime income, it taps into the longevity benefit base at $750 versus the account value, and they can get, in this example, $36,000 for the rest of their life. Whether they live to 90, 110, 115, 120, no matter what, that's what they're going to get. That is that guarantee that Greg was bringing up earlier. Some people like just, hey, you know what? I just want to turn it on now. North American, you tell me what I'm getting for the rest of my life, and they're content with that. Again, optionality. Don't have to use it if you don't want to, but it's awesome to have there, right? Especially for the people who have sort of a longevity risk concern. And I'll even go over an example of that in a little bit. So let's talk the plan gap. This is that Social Security one I just brought up quickly. So if the government ever reduces Social Security by more than 3%, you can tap into the longevity benefit base. So instead of the $600,000, you're going off the $750 as long as you take it in 12 equal installments. So in this example, they're getting $62,500 for 12 years. Again, don't have to do it, but it's an option. And the last one is the enhanced death benefit. So let's say that the death benefit at this time is $625,000. The beneficiaries can take the lump sum, right? Get $625,000, it's tax-free. That's great. But what if they want to get more and spread it out over 5 years? They can do that. They can tap into the longevity benefit base. So then they're getting $150,000 per year for 5 years, all tax-free. So they're ultimately getting $750,000 versus $625,000. Plus another thing, a benefit for me, like in my mind, is what do people do when they get a lump sum death benefit? They blow it out right away, right? So having this, you're getting more and you're getting it spread out over the 5-year period is definitely a benefit. Again, I'm going to say it's optionality. You don't need to turn these things on, but it's there just in case you have, that peace of mind. You want to do something a little bit different. Let's go over an example of the ideal savings account now that we kind of went through the product. And this client's name is Isa. Get it? Ideal savings account? Yeah, okay. So let's just say that we'll say Isa is 40. She's preferred non-tobacco. She has additional money, and really all she's ever been used to is maybe a bank for money. Like ever since she was a kid, just brought in savings account, nothing different, right? Let's show her something different, the ideal savings account. She wants more death benefit protection than she has. She wants tax diversification. Maybe she's heavily weighted in qualified money for retirement, wants tax diversification, upside potential, no risk, and there's a need for living benefits as well. The accelerated death benefit endorsement that is built into all of our products. I'll talk about that as we go along too. So you'll see here, the product is Secure Horizon. She's willing to put in $10,000 per year. Now remember, that money's going tax deferred, right? And it's actually, the death benefit is going up over time. Now, here's another thing I need to point out is if they pass away, it's where the death benefit is at time of claim is what the beneficiary is going to get. Okay, not where the death benefit starts, it's death benefit at time of claim. So this is sort of an increasing death benefit that would be an advantage for the heirs, right? Or if they have a chronic illness event, we go off the death benefit at the time of claim, not where the death benefit starts. So let's say now she's paying that $10,000 in. It's going tax deferred. She funds it all the way to age 65. And then she wants to start taking loans. So on that left-hand side, you'll notice where it says $49,608. Those are the fixed participating loans. What does that mean? She's taking loans that are going to be tax-free, and the loaned portion of the money still earns index crediting like it never left the policy. So think about this. This product, upside potential with no risk, grows tax deferred, a tax-free death benefit to the heirs if she passes away. There's living benefits built in there as well, and there's that potential tax-free income, right? That's why this is the ideal savings account. And the optionality that you have in this is just so much greater than any other product out there. And I'm going to show you an example of that. Actually, before I jump to the next one, I scrolled down here to show after she stops taking the distributions at age 85. If you look at the black arrows down at the bottom, if you can see that, ultimately think about it this way. She would have paid in $250,000 tax deferred. Look what she would have got in tax-free loans. Almost $1 million. That's attractive. And it grew tax deferred. This is the ultimate tax advantage solution in the industry because of deferral, tax-free death benefit, living benefits, and then the tax-free income on the backside. The closest vehicle out there to this is going to be a Roth. But there's limitations what you can put in for a Roth. It doesn't have the tax-free death benefit on there, right? It doesn't have that leverage with the living benefits. All more reason to be looking at IULs. Now, here's another example of like where you can show, like this is a third-party system where I took the illustration, the Secure Horizon, and I ran it up against just your conventional savings plan, right? Where somebody just goes, I'm just used to putting it in a bank. Why wouldn't I just do that with my additional $10,000 a year? Here's why. You can see the $10,000 going in on the life insurance plan right here in the IUL and the conventional savings plan. It's a savings plan, so what happens every year? You get taxed, right? And right now a savings plan, maybe 3.3, whatever it might be. In this instance, I'm showing 3.3, right? So now you can see they're putting in the $10,000 against the life insurance. Well, look at this death benefit here in the right-hand column. That is that leverage conversation, right? They pass away tax-free to the heirs. You're easily beating out that conventional savings plan. Or if they have a critical or chronic illness event. So now let's go down to the next page. They started taking those distributions at age 65 and they want to take them for 20 years. look how strong the IUL is going, paying that tax-free loan out for 20 years to age 85, and the product is still alive. It's still increasing, right? The account value still goes up. The death benefit still goes up. Look what happens to the conventional savings plan. It runs out of gas at about age 72. So this is just an additional report. It's a third party tied to the North American software. Innsmark, you might be familiar with it. Again, like, here's the thing about it. I know the output isn't the prettiest, but the numbers speak volumes. Okay. So I'm going to go over another example here of where the optionality of the Secure Horizon and IUL is going to shine. We'll just call this life insurance retirement plan. So here we have a 50-year-old female, preferred non-tobacco, needs more death benefit protection, has additional money, wants tax diversification. This person is doing well, okay? They're a high income earner. They're maxing out their 401k. They're maxing out their Roth. They're like, you know what? They understand, like, oh, when I get to retirement, all of that qualified money, that's going to be a major tax hit, right? Also, she has longevity risk concerns. She's afraid of outliving the money that she has. So let's put it in action. She's willing to put in $25,000 a year for 15 years or to age 65. You'll notice on the right-hand side, it says LP right here. That means life pay, okay? She got to age 65. She goes, you know what? I want to start taking a guaranteed income. North American comes back and says, this is what you're going to get for the rest of your life, whether you live to 90, 100, 110, and she's fine with that. She had the longevity risk concern. So you'll see that 32 and change go all the way out to 120 on these illustrations. Very powerful stuff. Okay. Again, that's that whole optionality, and people like to know that I can guarantee a life pay option at some point on this product, no additional cost. Now remember, we're going off that longevity benefit base instead of the account value if you turn that on. So the optionality, again, I've probably said it 10 times, that's where this really shines in the Secure Horizon versus any other product out there. So the last example I wanted to go over was going to be a little bit of a different, this is more of like a replacement thing. We're seeing this a lot right now where we're running into people who have underperforming life insurance products, whether it's a VUL, current assumption from way back in the day, whatever it might be. It's underperforming. A carrier is telling these people, you got to keep pumping money in this thing to keep it going. And at this point, they're like, I don't want to do that. I got to look for something better. Here's a prime example. Here we have a 50-year-old male, preferred non-tobacco. He has 1035 exchange of $500,000 in existing policy, not happy with, underperforming, and he has no living benefits. He has no LTC coverage. He needs that peace of mind. So he can put it in the Secure Horizon because right off the bat, remember, we have living benefits. We have the critical, we have the chronic, we have the terminal illness. Okay, the one that people are going to focus on the most is chronic illness. Why is that? Because that's what people sort of equate to long-term care, even though we can't call it that. If they can't do 2 of 6 ADLs, they can accelerate up to 24% of their death benefit each year to help pay for that chronic illness that they're going through. Okay. And it's not reimbursement. It's indemnity. We don't need receipts. As long as it's physician certified, they can't do 2 of 6 ADLs. We just give them the money. They can do whatever they want to do with it. And this page on all of our illustrations is definitely a great reference point to what they're actually going to get at certain ages if they're accelerating a certain amount of money in the terminal, chronic, or critical illness realm. But again, this person wanted the peace of mind. So Secure Horizon, just like all of the North American products, has the critical, chronic, terminal illness. And this is what it looks like. There's the $500,000, 1035 into the Secure Horizon. The leverage off the bat is almost $1.3 million. I forgot to put this on the last slide. So this is an actual case that I worked with. His death benefit on the existing policy was just below $1.1 million. So we already improved the leverage with the death benefit. He's getting more upside potential with more optionality, and he has living benefits built in. So there's the $500,000 1035. The death benefit starts almost 1.3, and look at the values going up. I'm only showing 6% in the right-hand column because I'd rather under-promise and over-deliver. We're a little bit backwards in the industry right now. People always want to show the highest they can in the right-hand side. I don't think you need to do that. I think you can scale them back. You can scale them back to 6 or 5.5, because the most important thing is going to be like the ideal savings account, right? It's the tax deferral, tax-free death benefit, loans, living benefits, and all of those features. So that's going to be that secure horizon. And this is sort of that 1035 replacing an existing policy that's underperforming. So with all that said, I know I covered quite a bit here in a short amount of time. Wanted to give you the case studies, the ideal savings account, and where this product is going to fit. But if you're looking for an IUL with optionality, this is going to be the product.
AJ, that's awesome. I love that last example of it. It's how many people get together with their clients and they're having that discussion and they uncover some of these policies that are out there, and they're in their mind, they're like, well, what can I do with this, right? If I could reposition it and have it benefit them even more, I think that's awesome. I think that's a great benefit that North American has done. So thank you. I appreciate that. For the group as a whole, let me just reshare here real quick on a couple things, and then we'll wrap it up for the day. It looks like it's snowing. All right, so a couple items, next steps, right? In terms of your clients, you're thinking of somebody and you're saying, hey, listen, I need to, maybe understand, does my client or would my client qualify for this? Your client, this isn't necessarily for everybody, but what we do at E4 is we want to make it simple to go and talk through or work through and design with people like AJ on, would your client qualify for something like this? So the timing is important, because a 50-year-old who waits until 60 is going to be less insurable than that 50-year-old. Now, granted, lifestyle and all that could come into play, but the reality is, from a number standpoint, that is true. So timing is of the essence, and making sure that you reach out to an RVP or talk to somebody at E4. We have a whole team that can put together these illustrations, just like the unique illustration that AJ showed. We have tools that can do the same thing, and make sure that you actually have that and are, have those available for you to use with your client. Our underwriting process here, these are your affluent clients that you're working with, and we want to make sure that the experience that you have and that they have is going to be easy for them. Number one, we're going to be asking some health questions. We have a proprietary AI platform that actually allows us to go grab medical records, do grab information from them, order blood, urine, all that kind of stuff that we would need on a paramed for the client. And then what we do is we pull that information together. And because we're using AI tools, the efficiencies, what usually takes 4 to 6 weeks, sometimes we can do in 40 minutes to 4 days. We're pulling all that information together. It's easier for us to do a quicker turnaround for you. We make sure that the financial fit will follow through on the guidelines of North American or any other carrier that we work with. And then ultimately, you're doing a design option that best suits your client's needs. All right, so the goal is making sure that, does your client qualify for the ideal savings account? I think in many situations, being able to address this and being able to have the dialogue with your clients is going to give you more opportunities to help them reposition assets, reposition their thought process on what does an ideal savings account look like, because most people don't and have not been given this type of approach explained to them. And I think taking the time to practice it, making sure that you're working with somebody at E4 to actually go through that, who will actually help you through that process, makes the difference for you as an individual and what you provide for your clients. All right, so wrapping it up. The big thing for us is that making sure that you have access to information like this at any given point in time. And this episode is actually going to be available on our BREWcast on our YouTube channel, or you can actually go to e4.insurance. You can actually subscribe to our YouTube channel. I don't know why, but subscribe seems to be a hard word for me today. You can go to our YouTube channel, and and watch this at any point in time. So you'll never miss an episode. You'll get, new releases that come, and we do that every the first Wednesday of every month. So our next BREWcast that's coming up is Disability Awareness Month, and it'll be released at 10 a.m. on May 6th. I want to thank each and every one of you for taking the time, investing in yourself, investing in your clients, and investing in a way in which you can engage your clients a little bit better with an ideal savings account. Thanks for joining the BREW, and we'll see you next time.